With me right here. Chandra, good morning. Thank you very much for joining us here on CNBC TV 18. Last year, the same time, when we were sitting and talking about what FY15 will look like, you did sound very optimistic. You said that, it would be much better than FY14, or better. I'm not sort of picking words there. But it's been a difficult year in comparison to what you had laid out. Would you put most of that difficulty down to macroeconomic forces, or would you say that there have been some execution slips as well?
I think if you really see, the slip has been a slight disappointment in Q2 it started, and then it kind of carried through. We couldn't
make up for
that.
Sure.
And I would just be able to. I would not be able to just say that whether it's execution or macro.
But you would know, right?
To some extent, I mean, it's because the misses were very slight, very small, and maybe sometimes it is a volatility in a particular segment. I mean, telecom, as I said, has been volatile, and now we feel energy is going to be tough this year because of the oil, etc. But I wouldn't entirely be able to put it on macro. It's just that expectation and our performance.
No, so if you're not entirely able to put it on macro, then it would be fair to say whether it's telecom or even the problems in your insurance business on the Diligenta front have been difficult to fix, at least intra-year. Maybe you will be now able to fix them here on. You've, I think, indicated that they've bottomed out. I'll get into specifics on that front in just a bit. But does that indicate that, sort of somewhere execution has maybe slowed down? I don't mean it as a criticism, just to understand what the year was like.
No, it is not execution. It is the nature of certain parts of the business. I mean, Diligenta deal cycles are pretty long, and we don't have a solid pipeline in Diligenta. So that's hurting us.
That solid pipeline is an execution miss.
That's not an execution, it's the demand.
Okay.
It's more a demand.
So you'd say 80% macro, 20% execution, or 100% macro?
Macro and demand.
Macro and demand. Demand is macro.
No, 80% is macro, 20% is demand.
But the demand is macro at the end of the day, right?
Then you make it.
So no execution slip is your assurance.
Execution has been solid.
Okay, fine. As we sit here for FY16, what is your outlook? Will FY16 be better than FY15?
I'm not going to get into that. You know that. I'm going to.
But FY15, you've admitted, has been a difficult year. So are you saying that FY16 was that
FY16, the way I would put it is that the environment is good, barring the three headwinds which I outlined in the call yesterday, which is volatility in the telecom sector and energy.
And insurance, Diligenta.
Diligenta will still go through a certain amount of degrowth. Barring that, I think the environment is quite solid. India, we have to see. India has done well compared to where we started.
Okay.
But we have to see whether it's going to take off or it's going to be still a slow growth.
Can't tell as yet on
Can't tell as yet.
Okay, so given that you've just laid 80% of last year's blame on macro, when you say that the environment looks good, that means FY16 is going to be better than FY15, at least on the macro front. That's your expectation as we stand here today.
You see, you learn every year. You learn every time what not to do. This is something
what
I've
not
learned.
To do or what not to say at the beginning of
What not to say, what not to do. Both. So I'm not going to make a statement.
You've had an incredible 5 years at TCS. I know you celebrated 10 years, with a special giveaway to both your shareholders as well as your employees, and congratulations on that. But I'm looking at half of that. 5 years, in FY10 your revenue was 6.3 billion, I think, approximately that. You had about 160,000 employees. This year you've closed with above 15 billion. So you've gone from 6 to 15 billion, in FY15. 310,000 employees approximately. You've done really hard and fast in the last 5 years. Is it realistic for us to expect that you continue running at that pace in the years to come? Does base effect, size, start becoming a bit of a drag, just so that you can tell us what to expect from this mega-sized TCS as opposed to what the last 5 years brought us?
I know some analysts have also written about base effect, but I don't quite subscribe to that view. The reason for that is in the overall technology business and IT services industry, we are still very small. Our market share is very small. Second, the the effect of technology is only getting deeper and stronger in every business. So the opportunity and the addressable space that we have is enormous. And the third is TCS today, in terms of capability, in terms of people, talent, intellectual property, market positioning, is in a much better position to capture many of the opportunities that we couldn't have done several years ago. So given all this, there is no reason why TCS should continue to perform exceedingly well.
Okay. Yeah, let me just bear with me for a few minutes. I want to bring up some numbers for you over the last 2-3 years and explain to me why we've seen such a big drop, right? For instance, in the geography-wise revenue growth position, North America grew 27.4% in FY13, 28% in FY14, 13%. I'll admit these are rupee numbers, but nonetheless. Latin America, 40%, 34%, this year 5%. UK, 44%, 32%, this year 10.7%. Continental Europe, 21%, spiked to 51% in FY14, 19% in FY15. If I look at domains, the top 4 domains that contribute about 75% to your revenue, BFSI grew at 29% in FY13, 29% in FY14, 9.8% in FY15. Telecom, 20%, 25%, 8%. Retail, 41%, 34%, 13%. Manufacturing, 37%, 34%, 13%.
There's a pattern here, okay?
Yeah, there's a pattern. These are rupee figures, I'll be clear to viewers as well.
I think that's the fundamental problem. I think you need to, when you're looking at...
it's a very big fall, just
No, but it's a lot of it is currency. Let me just give you 2 or 3 statements only to explain this. I think if you look at the constant currency, there is not much of a gap. If you, for example, in Europe, if you take what you see as 19%, is actually in constant currency terms 28% this year. So if you compare it with a 34% or a 38%, that is also the currency favoring on the other side in the earlier year. But to some extent, I would say that in some years we've had a good growth in North America. North America this year we have delivered about 13% growth, I think. And we have done better than that in the earlier years. And a couple of sectors have not grown well in North America to the extent that they should have grown. But that's not an indication of the future. Our pipeline is pretty strong. Deal closure even in this quarter, out of the 9 deals, 3 large deals were closed in North America. And again, in North America, our size and scale, while it is $8 billion business, it is still very small share of the market. So I don't think that...
No, I get the point that you're still a small piece of the pie.
You need to do this analysis on constant currency.
Okay, so on constant currency terms, on your full revenue figures, in FY12 you grew 23%, FY13 16%, FY14 17%, and FY15 17%. The last 3 years you've maintained it. But in the last 3 years, have we seen some coming off the peak growth rates? I'm just going to ask. I'm not establishing it.
17% is a pretty good constant currency growth. I'll take that.
Okay. So
and any market will take that.
So I think my question is this. Is the best in terms of absolute growth rate figures behind us now? And you're saying no, that's not the case.
Yeah, that's not the case.
So the best is yet to come for TCS is your assertion at this point in time.
Always.
So if I connect that with the relatively positive outlook on the macro environment for FY16, I can draw the conclusion that FY16 will be better than FY15. But I'll leave it there. How are you going to fix insurance, the Diligenta problem? What are you going to do about telecom? Energy is not literally in your control in that sense, given where crude prices are. But how is all of this going to change?
Both the energy and telecom, to some extent, nature of the industry today, where they are in their own evolution. Energy, the oil, where it is, you yourself alluded to that. But telecom, the industry itself, especially the communication product segment, when I say telecom, I mean the communication service product segment, is going through a major transformation. They are trying to define their own future in terms of their business. So I think that will play a lot. While it will present a lot of opportunity, at the same time, it will also go through volatility. You are not going to have a uniform growth across the client segment, across the markets, and so on and so forth.
So have you bottomed out on insurance and telecom, or is there still some bad news in the pipeline?
Telecom, I'm not going to be able to say that because what I'm saying is that suddenly you'll see a growth, suddenly you'll see a dip.
So lots of volatility.
That's the point I'm making in
fair enough.
telecom.
That's fair warning.
And the insurance on the services side, excluding the Diligenta, we have bottomed out. It will continue to do well. It did reasonably well. It did about 11% last year. I kind of separated it out so that the market could see where we are excluding Diligenta.
How do you fix the Diligenta problem?
Diligenta is a long cycle business. It will do very well because it's a very, very solid platform, very unique platform, has very modern technology, but it will take time because the deal cycles are sometimes 2 years or so, sometimes 18 months.
So it could take all of FY16 to fix that problem?
It could potentially.
Okay. Are you talking us down? Because last year when you talked us up, you had to sort of revise the outlook 2-3 times in the year, so to speak, and therefore you sound very muted right now about what the year is going to look like. And I can't make out if that's because you feel not very confident about the year, or you're just sort of compressing our expectations.
I've given you enough qualitative comments. I'm just not getting to your number.
Maybe it's because you're not smiling as much as you normally do. What's the outlook on big deals, client additions for FY16? You've had a good quarter in terms of client additions in that sense.
Not only a good quarter,
and discretionary spend. Are companies looking as if they're going to reach into their wallets a little bit more in FY16?
Yeah, I think the client additions have been spectacular, I would say. I think if you see the metrics across the revenue bands, it's been really satisfactory, and I hope that we can continue that momentum. That's core to the TCS strategy, to be very close and relevant and bring our full services capability. So that I'm happy. The discretionary spend, my take is that based on the meetings I've had with clients, the discretionary spend on digital will increase almost in every customer that we work with. Some will have funding for that, some will be trying to take cost out from their current portfolio of IT spend and then reinvest it in digital. They'll have to find money. It's not that money is locked up for every engagement, but the engagements are lined up. So they will have to find the money. Somewhere they're getting funding, somewhere they've got to internally fund it. But overall discretionary spend on digital will be on the up this year.
On the up is what you said. On digital.
On digital.
Yeah, but digital is still a very small fraction of your business, or in terms of total revenues. So, talking about non-digital revenues, are you expecting discretionary spending to go up?
See, every discretionary spend in every business will be predominantly digital. Let me put it that way.
Will be predominantly
digital. And in some businesses, it will be some transformation because they have not done the transformation. For example, multiple ERP footprint they've got to streamline it. Some instances they've got to get their data architecture right. So those kind of initiatives will come in, but everything is going to be towards moving to digital. So most of the discretionary spend will go towards digital. But having said that, whatever be the size of the digital, it's all incremental. So and it will be on that for the years to come.
I know, but it's not your core business, so that's not
our core.
Well,
it will turn everybody's core.
It will become your core
in the next 4 or 5 years.
I understand that, but as we stand here today, it isn't your core business. Therefore, I'm trying to understand, in your core business, is demand looking good? In your core business, are spends looking better, incrementally better, substantially better?
See, most of the traditional business will be wallet share gains. That's where you find a lot of rebids coming up. So there we continue to win. So from our point of view, we've got to define demand as both traditional as well as digital.
So traditional demand is looking good, better,
very
substantially
good.
better?
So as I said, I walked through sector by sector. And barring these three, I have said demand, pipeline, order book is solid.
Big deals? Is this going to be a year of big deals?
There will always be a few big deals, and there will always be many small deals. So it's going to be a mixed bag. You're never going to do a year full of big deals or a year full of small deals.
A better year in terms of big deals?
I said enough, Menaka.
Well, at least I made you laugh, no? Now, I mean, that was some part of the goal to get you to stop looking so grim in some ways. You spoke of digital. Earlier on, a couple of quarters ago, you had said that, digital will eventually become a business of $3 to $5 billion in revenue, let's say in the next 2 to 4 years. At this point in time, would you want to revise that estimate in any fashion, downwards, upwards?
No.
Would you say, how will FY16 be different from FY15 in terms of digital? Are you seeing bigger sort of contract sizes, better margins? Can you give us some color on that?
I think, as I said, digital business will continue to grow steadily for the next several years, and both in terms of number of deals, size of the deals, contribution to our incremental revenue, every year it will get better than the previous year. So FY16 digital contribution will be higher than FY15.
How much will it be? You won't give a breakup. Okay. In terms of a year of investments, and I know you've been sort of calibrating investments to keep within your margin band, the stated margin band, so to speak, but is this going to be a year of enhanced investments if you expect digital to become the core of your business in a year or two? Are you pumping in more money on that front? Can you again talk us through skill sets? For instance, in the analyst call, you spoke of artificial intelligence-linked platforms, right? So if you can talk us through some of the new skill sets that you're developing in these spaces.
I think our investments go in multiple categories. One is cloud platforms. We have invested in a number of platforms, and for the first time we shared that the 7 platforms under that category grew 55% to deliver $125 million of revenue.
That's not your total digital revenue. That's a
no, this is just the cloud.
This
is just the cloud platforms. Then we have we announced yesterday that we have been working on an artificial intelligence linked platform, which we called it as services as software. The cloud platforms are software as a service.
No, you're saying?
No, that is software as a service, cloud platforms. This is services as software.
Okay.
Because they automate the services.
Okay.
And we will be launching that pretty soon. The pilots have gone off exceedingly well. And these are initiatives and anything to do in this area of digital reimagination, cloud platforms, services as software platforms, or design studios where we have invested big time in our Santa Clara lab. Those are areas in which we will just not cut investments. In general, our investments will continue as the pace is required, as is required. We will find the money. Money is not the problem.
I know money is not the problem.
So that is not the issue. The issue is that we just have to make the right investments, and we should be able to manage that investment, because there is also a bandwidth.
How are you seeing change in the kind of digital projects that are coming your way? Are they getting bigger in size? Is it sort of a volatile business? You don't see the steadiness in this business as you would have seen in your traditional business earlier. Can you give us some sort of commentary on that?
See, the way the companies are looking at digital is they look at end-to-end view, beginning to take a point of arrival view. That's what does it mean for me to adopt these technologies to be able to change my process end-to-end, whether it is customer-facing process or a back-end process, etc. And then a number of projects are kicked off. So typically you don't sign a very large deal. Sometimes you sign a deal as you are the digital partner for the customer, and many of those we do. Then execute a number of projects. So each project will be small, a few $1 million or less than $1 million sometimes. But then you are the partner for the customer in this digital journey, so you end up doing a large volume of work. But the pricing may be also higher, but the investment is also higher, because we are significantly investing in training. Okay. So our aim is to train at least 100,000 people.
Okay.
In different digital technologies.
Okay, we're almost at the end of our time. I have a couple of last questions. On the margin front, and I will ask Rajesh more detail on this, but on the margin front, should we expect that the stated band is maintained over FY16?
Yeah.
That's the expectation. Why is attrition so high? Has that become a cause of worry? I mean, as if it wasn't a bad enough year for you on the macro front, on the demand front, as you're pointing out, on the currency front. It's been a tough year from an employment and attrition front as well.
I think attrition has gone up about 0.8 to 1% quarter on quarter.
14.9%, right?
So every quarter it has been no, I think it has been like that in 2011-12, Ajay pointed out. The whole year of 11-12 was like that. So sometimes when after a lull in demand and the demand picks up across the industry, then you see this kind of spike in attrition. But I think we are focused on bringing it down. I'm pretty sure we'll get it under control and where we want it to be.
Chandra, competitive pressures in the marketplace today, are you seeing any big changes there?
No, it's okay, as usual.
Okay. So you're leaving us with the clear point of view that FY16 is looking better.
Yes. Looking good.
Is looking good. And you said the demand environment is better than last year, given how horrible last year turned out to be.
Menaka, I'm not giving any comparisons.
All right.
All I'm saying is that FY16 is looking good.
And looking good typically for TCS means that you outperform the industry growth expectations as set out by NASSCOM.
No, I'm not giving any...
Well, what does good mean?
I am not giving any comparative statement.
What does good mean? All right. Thanks very much, Chandra, for joining us this morning, and all the best for this